is Jonathan Schiessl of Ashburton. Jonathan, appreciate you joining us here on CNBC TV 18. What do you make of the manner in which global markets are falling? I mean, let's be clear. For 2 years now, the S&P 500 has gone only one direction, and that is up. We haven't had any meaningful correction that we've seen, specifically when it comes to the US market. Would you now say that volatility is something that we need to get used to?
Most definitely. I think it's amazing how quickly we get used to, or everybody's got used to this low volatility phase. But certainly I think a lot of people have been saying this year will be more volatile, be aware. But of course, in spite of that, when it comes, and it always comes when you least expect it, it causes the shocks. And I think clearly with modern trading systems and all these other new products that are around, the speed with which the volatility hits and the size of, quite frankly, the moves that we're seeing are a result of a lot of these new systems. So I think it's something we will definitely have to get used to. But all in all, it's after the moves we've had, it's not surprising.
It's not surprising. But Jonathan, what are the triggers that are impacting market sentiment? One, of course, is the possibility that the Fed may, in fact, have to hike much more than was earlier estimated or anticipated. Will growth continue to accelerate? Is that 4% number a given? Or is the market once again overestimating growth, especially for a key market like the US? What seem to be the key triggers weighing on the market today?
Yeah, interestingly, when you look at previous relationships in different markets, different asset classes, I think it's fair to say that over the last 10 years or so, with the era of QE and financial repression that we've been living through, some of those old previous relationships had broken down. And there used to be a very clear relationship between rising bond yields and falling equities. That relationship had broken down, and suddenly it's reasserting itself. You could argue the reason it's reasserting itself is because some central banks are withdrawing and trying to move away from quantitative easing, and therefore some of the old relationships are coming back. But clearly the global economy is doing well. The data looks pretty good, but obviously the rising bond yields and this inflation scare that's doing the rounds is keeping people awake at night.
Well, talking about keeping people awake at night, people in India watching what the global markets are doing, so certainly staying up, keeping a tab of what's happening overnight when it comes to the US markets, Jonathan. But let's just talk about India specifically, because we have been impacted, of course, by global factors, but back home, the local factor that perhaps is also weighing on the market's mind is the long-term capital gains. How are you seeing the fall in the Indian markets, and what's the prognosis from here on?
Yeah, I mean, obviously, when you're computing what you think your long-term returns from a stock might be, clearly you're going to have to now factor in that there will be a capital at CGT, which will slightly influence that. I think, as usual, we get these notices and we get these events happening, and then there's a period where there's some confusion about how it will work. And clearly we're in that phase at the moment where there's some unanswered questions. 10% CGT on a story, on a market like India over the long term, yes, it's something new we have to figure in, but is it going to derail the India story? To our minds, not. But clearly it's something that we've got to think about and consider into our long-term thinking.
We saw the markets recover, coming off almost 700 points off the day's lows today in India, Jonathan. So what would the call on India be in the near term? Would you use this as an opportunity to get into stocks? What would the strategy be for India specifically?
I mean, if I'm really honest, we've always quite welcomed bouts of volatility. The issue has been obviously with a market that's only gone one way over the last couple of years. We've always quite welcomed those bouts where weak hands are dumping quality stocks in many instances, and we've been able to pick up cheap stock. You don't get many opportunities like that in a market like India. So again, we welcome that. I think it is interesting to see this massive intraday reversal in the likes of India. And I think, to our mind, the fact is that we now have this quite strong domestic hand that is also now in the markets. And I think over the longer term, that will dampen down volatility, because After all, foreign investors, when they look at emerging markets, when they look at India, they often say, oh, why would we want to invest there? It's very volatile. The reality is the volatility, more often than not, comes due to events outside of India, and also because of foreigners piling in and piling out. Obviously, now we'll have a more steady domestic buyer. We think that actually the volatility will dampen down over time.
Okay, Jonathan. Well, on that note, we're seeing a recovery even as far as the U.S. markets are concerned. But thanks very much for joining us here on CNBC TV 18 to make sense of the volatile times that we're seeing across global markets today.